Hello, guys, and welcome to another episode of Tax and Financial Matters, the place where we discuss tax and financial matters. Welcome to today's lecture on the European Union Anti-Tax Avoidance Directive, commonly known as ATAD 1. I am pleased to guide you through this in-depth exploration of a key piece of European Union legislation that has reshaped the tax compliance landscape for multinational enterprises within the EU. Today, we'll dissect the core elements of ATAD 1, its objectives, and how it aims to curb aggressive tax planning. Let's begin. ATAD 1, formerly Council Directive 2016-1164, emerged in a post-financial crisis environment where there was a mounting pressure to ensure fair taxation and restore public trust in the international tax system. At its core, ATAD 1 aligns with the OECD's Base Erosion and Profit Shifting BEPS project and the EU's Commission's agenda to create a level playing field for businesses operating across borders. The directive was adopted by the Council of the EU in July 2016, with most measures coming into effect on January 1st, 2019, and the exit taxation and hybrid mismatch rules being applicable from January 1st, 2020. It sets a minimum standard for anti-abuse measures that member states must integrate into their national laws. The primary goal of ATAD 1 is to ensure that profits are taxed where economic activity and value creations occur. By introducing a harmonized set of minimum anti-tax avoidance rules, it curtails the use of artificial arrangement aimed at shifting profits to low-tax jurisdictions. With ATAD 1, all EU member states must incorporate these rules into their domestic legislation, promoting consistency and reducing loopholes that previously arose from the diverse national rules. ATAD 1 addresses tax abuse through 5 main mechanisms. We'll delve into each category in detail: the interest limitation rules, exit taxation, the general anti-abuse rule, CFC rules, and hybrid mismatches. Each of these elements work together to ensure that EU tax systems cannot be exploited by strategic tax structuring and arbitrage. Before ATAD 1, many multinational enterprises exploited discrepancies in national interest deduction rules to reduce their tax base significantly. By incurring excessive debt in high-tax jurisdictions, they could shift profits out through deductible interest payments. The interest limitation rule, aligned with the OECD's BEPS Section 4, sets a cap on the deductibility of exceeding borrowing costs. Under ATAD 1, EU member states must ensure that the tax-deductible amount of net interest does not exceed 30% of the taxpayer's EBITDA, or they may allow a fixed de minimis threshold of 3 million euros. Some countries have chosen stricter rules, but the directive sets this baseline to limit profit shifting via disproportionate financing expenses. As you can see in our example, we have Company A in a low or no tax jurisdiction, while Company B is in a high tax jurisdiction. Company A lends money to Company B through a high interest loan. When Company B repays on this loan, including the interest payments are tax deductible in Company B's jurisdiction, while the corresponding interest income for Company A might not be taxed at all or at very low tax rate. So as you can see, previously Company A in a low or no tax jurisdiction could previously unhindered lend out money to companies in higher tax jurisdictions, resulting in tax deductible cost for Company B, which lowered the taxable profit, while corresponding interest income for Company A was not taxed or almost not taxed. As such, with the interest limitation rules, such strategies are now significantly curtailed. Exit taxation rules prevent taxpayers from avoiding tax by reallocating assets or their residency to a lower tax jurisdiction without recognizing the build-up gains. By imposing a tax on unrealized gains at the time of exit, ATAD 1 ensures that these profits do not escape taxation simply through migration. Under ATAD 1, when a company transfers assets or its tax residence out of an EU member state, that member state can levy an exit tax on the market value of those assets. Payment can be deferred deferred under certain conditions, especially for transfers within the EU or EEA. This measure ensures that unrealized gains, such as intellectual property value, cannot escape taxation through mere reallocation. Example: if a company holding valuable IP in country A moves it to country B with lower taxes, country A can tax the unrealized gain upon exit, preventing a tax-free shift. The General Anti-Abuse Rule, the GAAR, is a broad measure ensuring that even if a particular scheme isn't explicitly caught by a specific anti-avoidance rule, tax authorities can challenge it if its main purpose is to secure a tax advantage. The GAAR looks beyond the legal form to the underlying substance, helping to ensure that the directive remains effective against evolving tax planning methods. Member states must empower their tax authorities to disregard artificial arrangements put in place primarily to gain a tax advantage. If, for instance, a complex chain of holding companies exists only to reduce tax and lacks genuine commercial rationale, the General Anti-Abuse Rule allows authorities to recharacterize transactions to reflect economic reality. CFC rules bring the income of certain low-tax foreign subsidiaries back into the tax net of the parent's jurisdiction. By doing this, ATAD 1 prevents multinationals from parking profits in places with minimal real activity and very low taxes. If a foreign subsidiary is taxed at less than half of the rate it will have faced in the parent's home country, its non-genuine income can be attributed back to the parent. However, if the subsidiary has genuine economic activities, actual employees, functions, and risks, the CFC's rules may not apply. This ensures that only artificial structures are targeted, not legitimate business operations. As an example, previously, a parent company could be placed as subsidiary passive income in a zero-tax cash box subsidiary. Under ATAD 1, that income is now attributed to the parent and taxed accordingly. Hybrid mismatches occur when two jurisdictions treat the same financial instrument or entity differently for tax purposes. This can lead to double non-taxation, one country granting a deduction while the other one doesn't include the corresponding income. ATAD 1's hybrid mismatch rules remove these loopholes within the EU, and ATAD 2 later extended these rules to mismatches with third countries. If a deduction in one member state is not matched by corresponding inclusion of the income in another one, the deduction is disallowed. Similarly, if a structure yields double deductions, one deduction is eliminated. Initially, ATAD 1's hybrid mismatch rules focused on intra-EU scenarios. With the adoption of the ATAD 2 rules, the scope expanded to include third country mismatches, further ensuring that the income is taxed once, somewhere. Explanation: the pre-ATAD situation, where a cross-border loan that is considered debt in country B, generating deductible interest, but equity in A, non-taxable return, is now neutralized. Either the deduction is denied or an inclusion is forced, ensuring that the income is taxed appropriately. ATAD 1 sets a new benchmark for anti-avoidance measures across the EU. By harmonizing rules and reducing complexity, it curbs aggressive tax planning. Subsequent measures, like ATAD 2, have broadened its scope, and the EU continues to refine these rules. The ultimate aim is a fair, robust, and transparent tax environment that keeps pace with evolving international tax challenges. In conclusion, ATAD 1 ushered in the new era of tax compliance within the European Union. Addressing interest deductions, exit taxation, abuse in general, CFC income, and hybrid mismatches, these measures ensure that the tax outcomes align with genuine economic substance. While legitimate tax planning remains possible, aggressive schemes that rely on artificial constructs now face robust countermeasures. Thank you for your attention, and I hope this comprehensive overview has clarified ATAD 1's significance and future direction. Please follow and subscribe, leave a comment, and have a nice day. Goodbye.